Hello and welcome to Commodity Champions, your weekly dose of what's brewing in the commodity space. I'm Manisha Gupta. And our attention directly goes to the oil market. The crude is trading near 17-month lows now, with a decline of nearly 9% in this week. The NYMEX is down 24% in 2018, while Brent is down 19% as well. This year, the eyes are now on the OPEC on how they will react to this slip. OPEC is suggesting that the effective reduction in supply is higher than the earlier estimates. They've also asked the members to publicly release the production levels. The OPEC is now mulling to accommodate Iran, Libya and Venezuela since they are exempted from the supply cuts. As of now, Saudi oil minister tells us that they are expecting the oversupply situation to subside by the end of first quarter 2019 in terms of production. It is at a record high levels right now, with the US producing 11.7 million barrels per day, followed by Russia at 11.42 million barrels per day, while Saudi Arabia is producing 10.7 million barrels per day. But moving on to the metals, we have gold prices, which are trading at a 6-month highs and is heading for its best quarter since March 2017. Experts are expecting gold to head even higher in 2019. The recession worries in US, trade war concerns and slowing global growth is also turning into tailwinds for gold. However, the Fed has signaled fewer rate hikes over the next 2 years, and that has cautioned for a bleak economic activity in US. The base metal prices like crude is also set to end the year in the negative. The economic slowdown in China, the trade war concerns and increased supply means that the outlook isn't getting better. To discuss this further and to get a better outlook for next year, we have with us Juerg Kiener of Swiss Asia Capital, and also joining us is Akash Doshi from Citi Research. Gentlemen, hi, thank you so much for joining us. Juerg, let's start with you first. And crude has been the talking point in 2018. We have seen huge volatile moves. Is the same scenario playing out for 2019 again?
I think, fundamentals haven't really changed that much. You still have a million barrels plus minus spare capacity out of production. That's been like that for 20 years, and if you look at the last 20 years, your oil price gone up and down like a yo-yo. So it's to a large extent derivative driven, but I think to another extent as well driven by the sheer fact that more and more oil contracts will be traded not in dollars anymore, and so these contracts will have to unwind, and that's basically not a very pleasant environment.
So, Juerg, what is your range then for the crude oil prices for 2019 in the light of everything that you've said in sense of fundamentals, some of them positive, some of them not so positive?
I think it's mainly the derivative meltdown on the oil side, and maybe attached to that, maybe even some of the credit issues in the oil market, but mainly I think it's really just the derivative structure which is changing.
Juerg, when the crude was at $80 per barrel, we heard some credible voices saying that it is headed to $100. And now that it's broken below 60, we have seen forecasts of 40 as well come in. What is your sense on the prices moving forward?
We can trade in the 40s for some time, just basically to unwind some of the malinvestments which have been done. But we all know the production costs for a lot of people is well above that. So you're not going to stay there for a long time, so the market will start to reboot on the end and start trading higher again, probably sometimes the second half of next year latest. And I think the other thing is the US dollar. You had a strong US dollar, and so you've seen all commodities being sold off, including oil, and now you start seeing probably almost a reversal of the dollar strength, because the flat yield curve doesn't really allow you very much participation anymore. It's a lower yield curve. So from that point of view as well, that the commodity space looks interesting. So it might turn already quicker than people think when you watch the dollar.
Let's also discuss the US dollar, because the currency has been an important play as well. So how do you look at the dollar now playing itself in 2019? What is your sense of its impact on the commodities and especially the industrial metals now?
Look, the fact that the rest of the world try to use less dollar tells you that there's some financial juggling going around by restructuring how business is being done. And during this period, the dollar can stay longer firm than we think. Once these people have restructured the way to do business, the demand of dollar will actually collapse. And then we're going to see probably quite a weak US dollar going forward.
Yeah, 2018 has closed quite flat to negative in the US dollar terms. Of course, we've seen gold gain up in the rupee, in Chinese yuan, in euro, in pound sterling, etc. But gold as an investment or a safe haven bet, what is your sense? Do you think more and more investments now coming this way?
I think if you look at the precious metal space, it's actually quite a mixed bag. If you look at palladium, you start seeing that you have a metal which is already in a bullish phase. It's in a bullish phase because the production side is relatively falling, and if you look at inventories, they collapsed. So you have now almost an environment of backwardation. Despite having a recessionary environment in the car industry, you don't have actually supply and inventory to basically keep production going, and so that means it goes up. And you have a very similar environment actually in silver. You have a very similar environment in the gold space, where you have huge paper contracts but very little physical. So these paper contracts are running for such a long time already and driving these metals into the ground that at one stage the supply issue is becoming a problem. And I think you start seeing that some really big houses are positioning themselves. They are restructuring the derivative book on the metal side, and that tells me the metals have actually great support.
So Juerg, if you had to choose between gold and silver, where do you see a more safer bet in sense of trade or in sense of investment?
Look, if you look at from a bet point of view to make a bigger return in 2019, I think people should start looking at silver. If people want to have more stability and an insurance gap, which has basically hardly any cost, then actually gold is probably the preferred metal to hold as a portfolio diversification.
How also do you look at the industrial metals, which are quite clearly marred by the concerns between the two major international powers, that is the US and China, both in their own sense major producers and consumers and market movers as well?
You know, if I look at the shipments out of all the base metals and even iron ore and coking coal, and I look at Australian exports, they're still rising. So that tells you the demand here in Asia is actually quite firm. So we have slowdown of economy. And as long as we don't go into a real deep recession where we have negative growth, I think that the base metals will find very good support, maybe not all of them equal. But if you look at zinc, it's been basically at almost an all-time low on the inventory side. You have backwardation in the metal. You look at copper, it's incredibly tight. You see that the refiners in China are basically charging one of the lowest refining fees ever because they are so desperate to get supply in. So the demand supply actually looks quite favorable, but right now, because the macro traders are shorting commodities because everybody talks about economic slowdown, it's a disaster, they are actually almost at bargain level. What's really interesting is that this trade at one stage will reverse, because as the economies get weaker and your corporate and your private sector are weak, the governments normally step in. And what do governments do in recession? Either they basically build inventories, infrastructure investments, probably not housing, but certainly infrastructure investments, and I think that's going to drive to a large extent the thing higher. And you have an economic shift in the car industry, which will need very different metals for electric vehicles than what you have in the old industry. So we're going to get two big shifts coming up into 2019, which will be very supportive for many of the metals and minerals.
So Juerg, when we started 2018, there was this whole theme about the electrical vehicles playing on how that would up the metals demand. And of course, the infrastructure push, the construction, the railroads, to a lot of demand expectation coming in for the metals. That clearly hasn't played out. But would you say that these themes would perhaps now play out for 2019?
I think copper looks really very, very tight. I think I mentioned that before. I like manganese, which is a very tight market too. I like lead. Just to name a few. I will be careful on the EV minerals and metals. We all know we're going to need lithium, but you know, in what form and shape lithiums will be running into the battery space in 3 years' time is another question. I like sulfide nickel. I like in general very, very high grade and good quality minerals. And if you actually look at the prices, everybody talks about copper prices. But if you look at the copper price in Shanghai and the copper price in the United States, it's very different. You had days where inventories on both sides were falling. The price in New York fell, and a falling inventory price in Shanghai meant the opposite, actually rising prices. So you want to have the best quality, the highest grade, because it's like if you look at fashion, higher quality demands a better price, and I think that's where people should be focusing on miners which are able to have the top end of the quality coming to the market.
So Juerg, where do you see the fund asset allocation weightages really going in? If you had to choose between energy, agriculture, precious metals, industrial metals, how would you divide your money in for all of these?
I think if you really look at the global picture, you see we have very tight money right now, and we have slightly higher interest rates in many countries compared to a year ago. So we have a liquidity drain. So people are deleveraging, and from that point of view, the base metals might have to suffer a little bit longer, but it's going to be the time people should start building the position. During this period, your credit spreads are widening, and that's where actually precious metal are really key in your portfolio. So you should certainly have some gold in your portfolio, physical gold in particular. And start looking at some of the best miners. I mean, they are 80% of the peak, so they are bargain levels. Basically, if you look 5 or 10 years out of the window, they will be perfect add-on. On the agri side, I think we had very hot summers. We're going to have probably very cold winters. So look a lot of dislocation on who's able to deliver, and depending on the crop, I think it will do quite well.
Juerg, since you mentioned about the agri-commodities, the agri-prices this year have been impacted by weather, by geopolitics, by trade concerns. In the Indian markets, we've seen even major concerns when it comes to the farm and agri prices. What are you choosing between this as a better bet for 2019? Look,
at the moment, one of the biggest risks we face is actually trade wars and geopolitical issues, which means a good might still come to the market, but it will have to be shipped in a different way, which have higher cost. Some of it might be boycotted or sanctioned, but it's true for almost everything, not just commodities. And that's going to be a challenge, I think, for many, many fund managers next year as the game keeps changing. I mean, if you look at the United States, who would have thought they will pull troops out of Afghanistan and Syria 3 months ago? And in return, who would have thought 3 months ago we're going to have, instead of a Russian bashing, a Chinese bashing? So the game gets replayed, and we're finding new opponents to bash in order to look good. And that's mainly political. I think the industry and the economies as such will continue to find ways to do business. And over time, I think they will disappear.
Juerg, thank you so much for that. And with that, we'll go for a very short break. But when we come back, we'll, of course, have full tilt towards the crude oil prices, because that is what all asset classes, countries and economies take cues from. We will be joined by Akash Doshi of Citi to help you understand on what you should be expecting out of energy space.